Hey everybody, how is it going? It's John here. I do videos here on investing, also other videos on things like travel, adventure travel, and then also real estate. Actually going to be coming out with a whole lot more interesting, I guess, programs or services related to short and medium term vacation rentals. I actually have a lot of experience with that. I've done over 700 basically rental transactions, right? Going back to 2005, and over many different properties here, basically in Southern California, right? Yep, just Southern California. But basically, in any case, what are we talking about today? We're talking about Amazon. So as you may know, Amazon this week actually split their shares 20 for 1. I'm actually an Amazon shareholder. I have quite a bit of Amazon. In fact, I think in both in the accounts that I have, it's actually the largest holding, which was I wasn't feeling that great about in 2021, but I also wasn't feeling that great about selling it either, right? And especially when the price was, at really high. I think if you take a look at the 52-week high, it's about 3,700 and change. When you look at their 52-week high, it's hard to see now because basically, it shows 188. So if you just, do the quick math on that, that's probably 3,700 and change. So 188 times 20. Yeah, 3,760 is the 52-week high for Amazon. But basically, yeah, I really struggled with that whole desire to diversify out of Amazon, but, not wanting to sell at something like $3,000 a share. You'll hear Warren Buffett and a lot of expert investors or investment professionals say that they have this opinion that it doesn't change anything. All you're really doing is you're obviously splitting up the profits into much smaller slices. But when you're talking about the average investor, people that are investing, $5,000 or $10,000 up to $100,000, it is certainly very significant when it comes down to really just two basic things. Number one, diversification. It makes it quite hard to diversify when you have the shares that high. Number two, it makes those decisions to exit that position, if you want to sell a little bit, it makes it a lot harder when the prices are that high. And then also, of course, enter. I mean, enter is kind of obvious because there's a lot of people that simply just can't get in because they don't have that sort of money. And even if they did, they don't want to put it all in Amazon or Google, right? But basically, the third is really margin. I actually do also invest with margin, certainly. Not the greatest situation to be in this kind of 2022 post-pandemic crash, but basically when you're investing with margin, you have to make some sales. You obviously have to make those decisions. So you're forced, of course, to actually depending on how responsible you are with margin, right? But you're forced to actually make those sales. So it makes those decisions much easier when those shares are much lower price. So I argue that it's very significant when it comes to groups like Amazon and Google, where their prices are so high, specifically Amazon at that 52-week high of $3,760. It makes it a whole lot easier to exit those positions and also, of course, enter it, right? Yeah, so let's take a look, everybody, real quick here. We can see the Amazon price here at 123. Kind of funny. It's like the price matches the market cap at 123 and then 1.25 trillion. So that is that. I also last week, everybody, I did some numbers for Amazon. I'll show you. I'll show these numbers to you here. I'll also link to that video in this video so you can see that video that I did where I actually stacked up all pretty much the top tech dogs, right? The FANG names, Amazon, Apple, Alphabet, Microsoft, Facebook, and then Netflix. Stack them all up. What I do, everybody, is I take a look at revenues, trailing 12-month revenues. I really always like to look at 12 months and then also gross profit. I look at gross profit for a lot of reasons. I think the most important one is that the actual gross profit margin percentage number says a lot about the business and goes into really my decision to actually how much I want to be a part of that business. For example, you take a look at Facebook, they have 80% gross profit margin compared to Amazon, who's got the most recent trailing 12 months of 13%. So if you take, and then another thing I do is I take their gross profits and I divide them into their market capitalization. So for example, Amazon at 19.5, when you take those gross profits, you divide it into their 1.25 trillion market cap, you come up with a multiple of 19.5. So what I did is I actually went in and purchased actually more Alphabet and Google last week because of that, because I see Alphabet and certainly Facebook as very, very attractively priced. If you take a look, Facebook stock has been slammed, certainly this year, and here they are. Their gross profits are only a 5 multiple of their market cap. So that's kind of pretty much a no-brainer when it comes to something like Facebook. Facebook might have certainly some headwinds when it comes to everything related to privacy and the kind of the popular opinion that they're experiencing, and some of their challenges with government, right? But in any case, Alphabet and Google's just a different story. So that was kind of a no-brainer for me. Alphabet and Google have not been hit as hard in terms of their price declines, their asset price declines, as Facebook and Netflix. Netflix is even down 70% plus from their 52-week high, and then Facebook is about their stock price has been cut in about half. So certainly it creates opportunities to take a look at the value of these companies to see what businesses you want to get into now that the price is a whole lot more attractive. And for me, I really went for actually Google. But as you can see from Amazon, still pretty attractive year-over-year revenue growth. With Amazon, they got that 23.7, so like 24% year-over-year revenue growth, and then their 1.25 trillion market cap. I don't think I'm going to be really super eager to sell too much of Amazon, but basically it does make that decision to exit quite a bit easier. And I think if you take a look at those valuations that I just showed you, it seems to me that it does look more appealing to go into, potentially like exit maybe a little bit of Amazon and go into more Google and Facebook, let's say. I'm probably not going to be going into any more Netflix. Certainly, I think a great company to own for the next 5, 10, 15, 20 plus years, but not really sure about the next year, right, with Netflix. So we'll have to see. But basically, I think certainly, at something like $100 some now with Amazon, it makes it a whole lot easier to trim some shares that I've actually been trying to trim for really quite some time. So I do foresee me, it's hard. Like I struggle with it because you figure, Amazon could be potentially the first $1 trillion revenue company in the world. But at the same time, it's like, how much bigger are they going to really get? They're going to get to, Tesla size and then beyond. Anyway, it's a great ride to be on, but at $100 a share, it is a pretty easy decision and a nice period to exit. Everybody, thank you so much for watching. Let me know what your thoughts are on the Amazon 20-for-1 stock split in the comments below. If you haven't seen any of my videos, my name is John C. Howard. I actually am going to start doing a lot more videos, and actually I'll have some programs and really some services on real estate. Like I said, I've done over 700 rentals transactions in that short and medium term vacation space. Everything from 30 days up to 3 years, and then everything in between, right? And then some a lot shorter than that, right? But the spirit of it is that you can make a whole lot more money from your place if you actually do shorter rentals versus just moving all the furniture out and doing long-term rentals, everybody. So I actually do have a background in investing. My first job out of college was Merrill Lynch. I did investment banking for a couple of years as well, and then worked for Sun America here in Los Angeles for 3 years. Other than that, I have actually been investing in stocks since 1989. It was part of the whole .com crash, experienced that. But aside from that, I've got a lot of 10x investments to my track record. And Netflix, when you look at the 52-week high, it was my first 100x, which is certainly not the case anymore since their decline. Everybody, thank you very much. And if you have any questions or comments, put them in the comments area. Thank you.